Hey, I hope you and your families are doing well. As stock traders, what do you think is better, buying breakouts or buying shakeouts and pullbacks? Let me know your thoughts in the comment section down below. What I'm going to do in this video is share with you how I go about buying pullbacks and buying shakeouts. To do that, I'll take you through a recent trade of mine that I'm still long at the time of filming this in Kinross Gold. You can see, as per the session insights, I was targeting this one on June 18th, 2024 as it put in what I call a shakeout demand tail on its 50-day moving average. So we're going to go through this trade. I'll take you through some of the practical things that I look at when I'm looking to buy a shakeout, looking to buy a pullback, some of the nuances as well, like looking at the stock versus the applicable group theme ETF. So I really hope you guys are going to get a lot out of this video. MarketSurge are today's video sponsor. If you're interested in a discounted trial, then you will find a link for that in the description and the comment section below. So we're going to begin with a high-level overview, and then I'll take you through the four components of a trade so you can understand the logical flow and process for how I think about trading these pullback, shakeout type entries in terms of how do I identify it, how do I control the risk, how do I mitigate the risk, how do I then optimize the profits, thinking about monetary gain, efficiency of the monetary gain, which is the time value element. So let's start off with a high-level overview. What we've got on the top, as you can probably see, is Kinross Gold. The various moving averages on my chart: black line 10-day EMA, blue line 21-day EMA, purple line, which is going to be very important for this video, is the 50-day simple period moving average. A couple of longer term moving averages, we have the 100 and the 200. Important for this video is we have GDX lined up on the bottom, so the date range is pretty much spot on. I got it as close as I can for you guys so you can see what Kinross Gold was doing versus the relevant group theme ETF, which is GDX, the gold miner ETF. Because when I'm looking for a pullback or a shakeout, I'd like to see that the stock is showing relative strength versus the applicable group or theme. We'll come on to that in the identification process, which kind of segues us into the identification process, doesn't it? So let's start off with the identification process here, okay? So when I'm looking for a pullback or a shakeout, there's certain candlesticks that I am looking for. So you've got to be aware of certain ones. So under the umbrella of what I call shakeout demand tails are three candlesticks. They are hammer candlesticks, doji dragonflies, and also Takuri lines. So Thomas Pasquale tested 4.7 million different Japanese candlestick combinations, and you can see the data lined up underneath these candlesticks. So I'm looking for these candlesticks under the umbrella of shakeout demand tails, but it's the context of where they happen and also knowing the stock. So Kinross Gold is a commodity stock, it's a precious metal miner stock. So I'm looking for these shakeout demand tails to form around the 21-day EMA or the 50-day simple period moving average over here. So here you get a shakeout demand tail. Here is kind of a shakeout demand tail. Here is a shakeout demand tail, but it's off the 10. I don't want it off the 10. Precious metal miners, I really want them off 21-day EMAs or 50-day simple period moving averages. Those of you who have watched my channel for a while, you may recognize this bar as well. Gap down reverse bar. You may recognize this bar as well. Trigger bar. So again, variations of different candlesticks. But let's get back into shakeouts, pullbacks, which are shakeout demand tails that I'm targeting. So what we have here is we have a first pullback to the 50-day simple period moving average. Now, precious metal miners have been showing some relative strength of late, and I would rather trade them on pullbacks. I like pullbacks to the 50-day simple period moving average in commodity stocks. Now, why is that? Because I'm looking for the larger operators, the bigger boys and girls, to step up and support the stock around that level. So what I'm looking for is those mental representations that I have that accumulation, absorption of supply looks like. So that's going to be variations of shakeout demand tails or gap down reversal bars. I want to see strength, I want to see buying, and I want to see a lack of supply. So you may be like, what on earth are you talking about? So as the stock is pulling back down here again, as it's pulling back down here, I'm expecting there to be some horrible looking bars. Again, I'm actually expecting large operators to maybe help push it down a little bit, scare those weak hands out. I mean, look how this kind of sets here, and then it just turns around like this. But after this bearish bar, what do you see? Interesting. There's another shakeout demand tail, which is undercutting at that point the last 4 weeks or so of price action. So already we're coming on to some important concepts here. When I'm looking for shakeouts, I actually want to see it undercutting recent lows. That could be a week, 2 weeks, 3 months, a month, 6 months. I want to see it undercutting recent lows. I'd then also like to have the reference point of a key moving average as well, just the deliberate nature of things. So this bar here is a very constructive bar. It puts in this shakeout, undercuts the last 4 weeks of price action, and the volume is only, you see this black line here, the volume is only 30 bar average. What's this bar telling me already? There's not that much supply. It rallies into the 1021 and then it comes down again. And sometimes you can get 3 waves down. You kind of have 1 here, 2 here, and then 3 here. I mean, maybe 3 is a magic number and all of that. It's just something maybe to know. I don't put too much emphasis on that, but oftentimes you can see kind of 3 waves of selling down. So what we then have is this shakeout demand tail here. So for me, this is the entry candlestick. This is the one that I want to be targeting it through the high, stop underneath the low. Now, why is this bar also important? Again, I'm trying to come at this from a supply and demand perspective, so you start to understand the psychology of the chart a little bit more. You understand the buying and selling. If you think about where the low of this shakeout demand tail is, it's in this red zone here, okay? So it undercuts the last 5-6 weeks of trading. So if you think about traders, think about yourself as well. Imagine if you were buying it coming out of this base. Imagine if you had an entry in here, or you were getting positioned in here, or you're getting positioned in here. Well, if you had a trailing stop at say the 10 or the 21, maybe that bar there would have got you. Interesting, right? Okay, imagine that you're buying somewhere in here. Okay, you're buying it in here. Maybe you would have exited your position there. And maybe you thought, do you know what? I'll place my stop loss on the low that day. Ooh, that bar there got you, didn't it? So do you see what I mean? It's really important to have awareness of you and your actions when you're trading, but also actions and awareness of other market participants. So if you're thinking about using, say, the 21-day EMA, this blue line as a trailing stop, if you didn't exit there, you probably exited there, right? And maybe you thought, do you know what? I'll be really, really clever. I'll place my stop loss on the low of that bar. Oh, you just got knocked out there, didn't you? Okay, maybe you thought, this thing's going to bounce. Yeah, okay, it's bouncing. I'll place my stop loss in here underneath the low. Then I'll place my stop loss underneath the low of this bar here. What bar just got you? You got it. That shakeout demand tail right there. So do you see how as price is coming down like this, large operators, I think, are doing their best to shake out weak hands. If you trade with a relatively tight stop loss, or you're looking to trail certain moving averages, you're a weak hand. Okay, you're not buying this thing looking to hold it for years. You're looking to trade it. Okay, as traders, we are weak hands. So can you start to see the games? Okay, imagine this. Imagine the hope that you have here, and then just whammy, as they say in Anchorman, just whammy, comes back down here. So do you see how a lot of traders, a lot of weak hands would have been being shaken out here? And then we come down to the 50. So it's not only just recognizing that candlestick, the hammer, the doji dragonfly, the Takuri line, but it's also thinking about the context. What are you seeing? How is the story unfolding? There's a story here on the chart. Sounds a little bit woo-woo, sounds a little bit out there until you start to see it. And you're like, wow, hang on a minute, there is a story. There's people buying, there's people selling. There's traders buying, there's not kind of really going to be kind of scalpers and day traders, but there's large operators in here as well. There's a lot of different market participants. Okay, the reason is it's commodity stocks, not really like a scalping day trading stock. They're going to be more focused on other stocks than stocks like this. But understand there's market operators playing around with this stock. And the question that I'm asking myself is, do large operators want it or not? And when I see these kind of games and then I see around the lows, wow, shakeout demand tails, potentially gap down reversal bars, I think I'm seeing the footprints. Like I'm seeing the footprints, the mental representations that I have for, wow, large operators are in there, they're absorbing supply, they're shaking out weak hands, they're accumulating positions. Then what's quite interesting with this shakeout demand tail, what do you notice about the volume? So you see that black line there that's going across, that's the 30 bar average. Well, the black line, the volume is below the black line. There's less than 30-day average volume. So the stock here has undergone quite a significant pullback around about 12%, about 4 times its 20-day ADR percentage. That's the average daily range percentage of the stock, excluding gaps. It's undercut the last 5-6 weeks of price action. So again, where would a lot of stop losses be? Maybe in here, maybe in here, maybe in here, maybe just underneath the 50. Remember, this bar here didn't look like that bar during the session. It looked like this bar when it was on the lows, but it didn't close like that. That's about developing that Bayesian mentality. You update your decision-making process as new information becomes available. So now we get a low volume shakeout demand tail on the 50-day moving average. Now, okay, so that is just the stock. So now what we want to do is we want to assess, is the stock stronger or weaker than the applicable group or theme ETF? The reason I say theme ETF is sometimes you have like kind of AI themes or EV themes or things like that. So you want to understand the group, you want to understand the theme. So for me, the most applicable one that I want to be looking at is GDX, the gold miner ETF. Well, as the stock is setting here, so it's going to be this day here, okay, that we're looking at, the 17th of June 2024. What do you notice about GDX? Well, it has actually just put in back-to-back shakeout demand tail-esque and the volume's drying up. So see how it's pulling down here? I know it's a bit small because I wanted to make the chart at the top bigger, but see how it's pulling down here, okay? And I have these moves down like this. There's really kind of like 1, 2, and then kind of a third move in here. What do you notice around the lows? Well, there's these tight little bars that resemble shakeout demand tails, and look at that volume again. Interesting. What's maybe that volume telling us? That volume is indicating to me there's not a lot of selling. There's not a lot of supply at these levels for GDX. Now that's interesting when we start thinking about the pullback here, and we also see leading stocks in the group. Here's a key: leading stocks in the group setting up in locations, regions where we would expect to see them set up. So Kinross Gold, leader of the group, we can see the relative strength. It's now putting in a shakeout demand tail off the 50-day, and GDX is just underneath it. So Kinross Gold is stronger from a technical perspective. Okay, Kinross Gold is above its 50, okay, but GDX is below its 50. And we're starting to see evidence that there's not a lot of supply. There's not a lot of selling at these levels, and the leaders are setting up. So when I'm looking to trade a pullback or a shakeout, invariably there has been weakness. There's kind of always weakness before it, right? Because it's pulling down. There must have been supply. There must have been selling. But I'd like to see strength. So I want to see weakness that the stock has pulled back, but I want to see relative strength versus the applicable group or theme ETF. In this instance here is going to be GDX. So if I'm looking at, say, semiconductors and it's pulling back, I want to be looking at the stock relative to its peers, relative to its group. I want to be trading the leaders. So even if it's a pullback, I still want to be trading the leaders in the group. I don't want to be trading the laggards. So this is a useful exercise I'll do, is if I see a stock pulling back into, say, its 21-day or its 50-day simple period moving average, and it's putting in this instance here, like a shakeout demand tail, I want to be aware of the group ETF. Now I have that on my platform. In terms of the various group ETFs, you can go and just Google them and find them yourself and overlay it like this. It's a really useful exercise. You can also do it a stock versus, say, the major index. So maybe the S&P 500, maybe the NASDAQ 100, maybe you go for the equal weights to remove some of the skewing. So the QQQE or the RSP for the equal weight triple Qs or the equal weight S&P 500. But this is a very useful exercise that's in the identification process. We're still in the identification process. And then what I'm going to do is think about targeting it through the high, stop underneath the low. So the identification then flows into the controlling a risk. So what I'm looking at is this here, the 20-day ADR percentage, the average daily range percentage. If you want the indicator that I use, it is this one here at the top. Okay, ADR percentage, that is the one that I use there. So it's 2.96%. What does that mean? It means the average daily range percentage of the stock from the low to the high, excluding gaps, is 2.96%. So what is also useful is when I'm thinking about the stock relative to the group ETF, so I'm just going to go back to the identification part because it's a key concept. What do you notice? The 20-day ADR percentage of GDXs, it's 2.3%. What do you notice with Kinross Gold? It's 2.96%. So which has a larger range? Which one is quicker? The stock is quicker. The stock has a wider range than the ETF. Now that's important. And the reason it's important is because if the group is going to start moving, I want to be in the leader that also has a higher 20-day ADR percentage than the applicable group or theme ETF. Now, why is that? Well, because if I'm trading a stock that has a slower 20-day ADR percentage than the group, if the group's going to go up 10% or 20%, whatever it may be, if the stock has a slower 20-day ADR percentage, it's probably going to go up less than the group or maybe match the group. I want to be in the stock where if the group is going to go 10%, 20%, the stock could go 30%, 40%, 50%. Okay, I want to be in the leading stocks from a fundamental perspective, a technical perspective, and also a quickness perspective as well, if you like, which kind of goes into the technicals. But that there is something also very important that I look at in terms of the controlling a risk, because the ADR feeds into the controlling a risk. I'm targeting it through the high, stop underneath the low. So my initial stop, assuming really good execution, is going to be 3.03%. Now, obviously, the more liquid stocks, invariably, the better execution that you are going to get. The less liquid stocks, the worse execution you're going to get. Why? Because the spreads are wider, more people trying to buy it there, there's more demand for the share prices. Okay, it's just kind of logical. When I'm targeting a shakeout demand tail or a gap down reverse bar, but specifically here a shakeout demand tail, I like to keep my initial stop loss around the 20-day ADR percentage. If it's less, even better. I will go to about 1.5 times the 20-day ADR percentage, assuming it starts with a 3 or a 4. If my initial stop loss starts beginning with like a 5, I'm really thinking about it with a 6. I very rarely have an initial stop loss that starts with a 6, kind of like 5% is really kind of my maximum. So it's also just a useful reference point, this 20-day ADR percentage, to think about the quickness of the stock relative to the group or theme ETF, relative to its peers as well, and also thinking about the initial stop loss relative to the 20-day ADR percentage. I don't need to be going in with a 7 or 8% stop loss. I don't need my stop loss all the way down here. The reason I'm buying it, again, what is my expectation here? The stock should move through the high of that bar there. It should not now undercut the low of the shakeout demand tail. That bar there should mark the low. There should be a re-emergence of an uptrend. okay, when I'm looking at gap down reversal bars or shakeout demand tails, okay, I'm expecting them to basically mark the bottom of the pullback, mark the bottom of a potential V, and I'm expecting that to then be the kind of change of character type bar, that then there is then a re-emergence of an uptrend like this. And then can I get other spots to then add to the position? So then I'll be looking for more setups to form, low pivots, more shakeout demand tails, trigger bars, gap down reversal bars. Can I build into the position if I think it's a leader? So for me, I don't need to be going in here with a 7 or 8 initial percent stop. 3% is all I need to know whether or not I'm going to be right on the trade. Okay, so that's how I think about the identification and the controlling risk. The risk mitigation, okay, we cover this in other videos, right? But then what I'm looking to do is I'm looking to sell par into strength. So for me, I then have mental representations. What am I expecting to happen after this entry? This is really important, guys. Okay, when you're taking an entry, what do you expect to happen afterwards? Like, what does it look like over the next day, 3 days, 5 days, week, 2 weeks? Like, what does it look like? What's the story in your head for the stock? Is it acting right? Is it not? So for me, the mental representations that I have from all my entries are pop, like this. So pop, test, and then a reversal, which in essence will look like a higher high, a higher low, followed by a higher, followed by a higher high. Now, what I'm trying to do, this then feeds into the process, okay? Identify, control, mitigate, optimize. So now, we're in the risk mitigation stage, okay? So can I free roll into the pop? What I want to do is sell part of my position, maybe a half, maybe a third, into the pop. Sometimes I do what's called active risk mitigation as well, where I'm then moving up my initial stop loss and I'm free rolling into that pop. So I'm taking off half, I'm taking off a third of the position, okay, maintaining a wider stop loss. Okay, underneath, I don't just want to move my stop to break even. Why? Because then on that testing action, I could just get knocked out of it. I would rather sell part, maintain that wider stop loss. Then what I want to do is sit through the testing action. So if the stock is going to play out like this, where it pops, it tests and reverses, can I then add to the position? If I get another entry as per my criteria, can I add to the position? Can I start concentrating? So I want to build positions as the stock is basing, as it's building a cup and handle, a VCP, a flag, a wedge, a Darvis box, ascending triangle, symmetrical triangle, all of that stuff. Can I build the positions? Can I pinpoint those entries? Can I concentrate in what I think are the real leading ones? So that's the risk mitigation. And then on the testing action, can I add? Can I then repeat the process of identify it, control it, mitigate that? And then can I optimize the profits? So optimizing profits, the best way to do this, I think, is study the stock, right? Study the action of the stock. Go back, look over the last year, 3 years, 5 years, however far back you want to go. If it's a new IPO, you're not going to have too much data, are you? But what I'm trying to do is get a feel, get a sense for this stock. So for me, I'm an intermediate term trend follower. What I want to do is I want to ride 10-day EMAs as trailing stops. I want to ride 21-day EMAs as trailing stops. Maybe I want to keep some back for the 50. Depends on the context. Is it kind of early within its own kind of price cycle? Or those of you who studied the works of Wyckoff, has it come out of a phase 1 base? Is it maybe early in a phase 2 uptrend? Or is it like really late stage? It's a 4th stage phase 2 uptrend base. I probably don't want to be using the 50 then. I want to be using a quicker moving average. So again, as we're talking about in this video, context, right? It's really important. What are you seeing? Where are you seeing it? How is it unfolding? But for me, I want to go back and I want to study the action of the stock and go, okay, what do I think is going to be optimal? So here's how I think about optimizing profits for all of my entries, right? Breakouts, shakeouts, pullbacks, whatever you want to call them, okay? If I bought Kinross down here, okay, let's say I had an entry, let's say I bought this as it's breaking out on the earnings, okay? So this down here, right? What I want to do is I'm imagining, okay, if I bought it here and I could go back a year, 3 years, I want to study these because this is kind of an okay base. Again, it's a commodity stock. They're going to be more choppy, but you got like a bit kind of Darvis box-esque, right? It's kind of a bit of a Darvis box, bounce off the 21 a couple of times. What I'm then doing is going, okay, had I had an entry right there, what would have been optimal as a trailing stop? Now, oftentimes it can be a combination of things. So I'm gonna ask myself the question: do I think the best moving average as a trailing stop is the 10-day EMA, the black line? Do I think it's the 21-day EMA, the blue line? Do I think it's the 50-day simple period moving average? Now, when I'm thinking about optimizing profits, there's two main components. I'm thinking about percentage gain, so the size of the gain, but I'm also thinking about how long did it take, how many days, which is the time value element. So if you look here, the first close below the 10 and the 21-day EMA is this bar here. So they're actually the same. If you look at the first close below the 50, we haven't actually had the first close below the 50. But imagine if this bar does. So what I'm then doing is going, okay, what was the percentage gain of, say, the 10 and the 21 relative to the 50? What do I think is better? What do I think provide the larger percentage gain and also have the better time value element? Now, I think the best way to determine that, go back and study the stock. It's not looking at, oh, well, some analyst has got this price target of $12.29. I'm not doing that. I'm going back and looking, okay, from this type of setup, how does the stock like to move? That's the humility part, where you have your process, you have your framework of, okay, this is how I like to identify trades, how I like to control the risk, mitigate the risk, and optimize profits. But there is a fluidity aspect, a creativity aspect, where you let the stock also dictate that. Okay, how does this stock like to set up? How should I control the risk in those instances? How should I best mitigate the risk? When it starts moving from these bases and it starts trending, how does it trend? Does it get short term really extended? And then I just want to potentially sell into that pop, so I move it around. Do I potentially want to kind of sell into that pop, or do I want to use some of these moving averages as trailing stops? Now, you may prefer the 9-day EMA over the 10-day EMA. You may prefer the 12.5-day EMA over the 21-day EMA. But the thing is, study the stock's action. What does the stock say? And remember as well, extended stocks can get more extended. So a useful thing that I use is, imagine on this day here, imagine if you're just like, wow, this is stupidly extended, la la la, all of this, and I'm just going to panic. What I find is useful is a principle from Davis. Let your stop loss decide. Let your stop loss decide. So what I'll also have is 10-day EMA trailing stop, 21-day EMA trailing stop, 50-day simple period moving average as a trailing stop, but also move my stop loss to the lower of the day on all or part of the position. Depends how extended the stock is, depends how I'm kind of feeling about it, the general market, its brother sister stocks. But on this day here, if you're like, this is extended, I'm just selling it. This is the kind of mistake I see so many traders make, and it's a Davis point. Let your stop loss decide. So what I'll do is just move my stop loss, lower the day, lower the day, lower the day, lower the day, lower the day. And then you're taken out up here on all or part. Again, subjective, discretionary there, okay? So then you're choking the trade off deliberately, but you're still letting an extended stock get more extended if you want it to get extended. Okay, you're just letting the stock decide. Let the stock decide how far it wants to go. Okay, the biggest mistake I see, like seasoned traders make, is they sell their winning trades too early. They don't let it ride. And I actually think a really, really useful thing is just lower the day, lower the day, lower the day, lower the day like that. Choke it off that way. But again, it's based on the character of the stock. Go back and look. Is doing that more optimal relative to the 10-day, 21-day, relative to the 50-day? That is for you to decide. So thank you very much for watching, guys. I appreciate all the support on the channel. If you're new here, please do consider subscribing for more trading related videos like this. Thank you very much for watching. I will see you in a future video.